Tutski. No, no, thank you though.
If I could go back in time, what would I tell myself to stop doing and stop losing as much money as you usually do when you start? Before you blow up an account or two, these are the first three things I thought of that can hopefully make an immediate impact. Let's get into the first one. Correlation. What the hell does that mean? All it means is that most of the time things move together. This is especially true for the US stock market. This is very true for crypto, unless you're dealing with some obscure altcoins that have their random pump and dump scams and things like that. For the stock market itself, there are exceptions. Obviously, if you pick an individual stock, it does not have to move with the overall market, and there are numerous times where it will not. But for the most part, the theme behind this is it's very hard to go against the broader market. So if you take a look at the quote here, rising tide lifts all ships. If the stock market is ripping higher, it's going to be very difficult to have a good short, even on a name that might be weak and might be dropping. I thought this one was interesting because you can see how highly correlated even markets across the globe are. For the most part, I think the theme is there. If the market is going up, don't try and go short. Have the market help you succeed. Don't fight against it. All right, for this one, I'll actually move out of this so you can see this chart, and we'll make it bigger here. But the theme here is when you enter a trade, you always need a plan. The most important part of it is, when am I exiting if this goes against me? If it's not going your way, what price will you sell at? Or what percent will you sell at? Or what kind of trailing stop will you have? And I wrote here, the worst thing you can do is go in with no plan and try to average down a losing position. So let's take a look at this chart really quick that shows this beautifully, because I've been guilty of this many a times, especially when I first started. You go long here 1,000 shares, could have taken a profit there, get greedy, think it's going higher, it goes against you. Think, okay, I'll average down. I'll get my average price lower. I put another 1,000 shares here at the second lower low. Chops around, another leg down. I'll just average down again. The worst part about this kind of thing is that equity, that liquidity that you could have been using for something profitable and doubling down on a good position going in your favor and making more percentage points, you're now stuck in a loser. Another large drop, and now you started at 52 and you averaged down twice, and now you're down a huge loss. Instead of just having some kind of exit criteria, maybe, if it drops below 50, I'm out, right? And you're down your 1,000 shares and you take a small loss, but you're out to fight another day. Even going long here, taking a small loss, going long here, taking another small loss, and then going long here again and taking a third small loss would have been exponentially better than getting stuck trying to average this down and selling here at the bottom. This is the quickest way to go broke. So have a plan, have your stop losses set, have some criteria for your trades, and don't be a degenerate gambler, basically just averaging down any kind of losing position, thinking that it might come back up, because that's the quickest way to blow your account. The last one, this might be a little bit controversial, but if you're a beginner, if you're someone just starting out in the markets, you're going to get crushed trying to do intraday trading. Yes, you might be successful for a week, a month, maybe a couple of months. All those YouTube videos you see with I made $1,000 profit today scalping.
Wow.
Most of those folks make more money on the YouTube videos than they do actually trading. I would actually argue that they don't trade mainly for a living, and they make more money off the YouTube videos teaching or selling their courses and things like that. Don't day trade when you're first starting. This is another quick way to go broke. This also compounds with the last slide that we just looked at, not having exits or stop losses. You can blow your account up in 30 minutes. Hell, you can blow it up in 5 minutes. If something goes against you, you start averaging down, and it just runs away from you. Forex is another one. Forex is one of the most liquid markets in the world. You're basically fighting against huge supercomputers running algorithms. Forget it. All those Forex traders that are quote unquote successful for a couple of weeks, a couple of months, ask them what their P&L is over a couple of years. The best way to get into it is just start doing long-term investing. Buy and hold a couple of things, get your feet wet, and then get into swing trading with a plan of holding positions for a month, couple of weeks, buy options 2 or 3 months out, see how the trade moves, see how the option price moves, how the option deltas affect the price as time goes on. Take small positions, 2, 3, 4% of your account. Take things that are longer dated. Start doing things like 0 day to expiration options. You're going to light that money on fire. Yes, you might get lucky, but it's basically just gambling. You might as well just go to the casino and put it on black. That'll probably be a better ROI than throwing it into the markets and fighting against pretty much the biggest banks, algorithms, some of the smartest people on earth that you're putting your money up against. Hopefully this made some sense and you can avoid some of the pitfalls and preserve and grow your capital. Thanks for watching.